All right, so hi guys. Last week we reached one of the peak periods of pessimism in the markets. It's like a lot of people out there were saying, it's the end of the world, we're all gonna die, right? And didn't help that the mainstream news came out with all these scary articles on Bloomberg. They said that a global recession probability has risen above 98%, triggering a severe recession signal. And I showed you this article last week. And it showed that, again, there's a 98% probability that we are going to go through a global severe recession. So peak pessimism. And ironically, I told you that historically, whenever the news was so bearish, whenever people were so scared and negative, that tended more often than not to coincide with previous market bottoms. Not all the time, but more often than not. And a survey of the retail investors in the US also reached peak pessimism last week, right? It reached like 60% of retail investors were bearish. More than 60% have given up on the markets, have sold out, have panicked. And again, this has previously coincided, interestingly, with market bottoms, okay? So the question is, what happened? With all this pessimism, the market, start of this week, it rallied, right? We had a very strong rally for the last 3 days, up like almost 6% in 3 sessions. So why is that so? Because I said many times that the market is kind of like a rubber band. When people get so pessimistic, get so oversold, it tends to snap back. So you can see the last 3 days, the market actually snapped back above that previous low on the 17th of June, setting up a potential double bottom pattern. So the big question on everyone's mind is that, hey, can this rally be trusted? Could this be the start of a new bull market? Which of course doesn't go up in a straight line, right? Could go up, go down, but eventually could this lead to new highs in the market, a new bull market, or is this simply another trap? Is this another bear market rally that's going to sucker me in, get me excited, I'm going to buy and kill me one more time? Well, let's find out more in this video. I think that for a lot of people, it's really hard to trust this rally, or in fact, any rally that comes. Because like a jilted lover, it's kind of like you loved before and you kept getting let down. You kept getting cheated, right? It's like you got cheated twice, where the market went up, yes, it's going up, and then it disappointed me. And yes, it's going to go up, it disappointed me again. And it's kind of like relationships where, again, like a jilted lover, you love someone and cheated on you, love someone cheated on you, and now it's like, hey, there's a new love and I've seen this movie before, they're going to cheat on me, so I'm going to bail out. Or you know what, I'm not even going to go into a relationship. So it's the same thing. I mean, think about it. Sure, if you have been cheated on before, if you have had your heart broken like 1 or 2 times before, which I had in the past, like who hasn't, right? But if you have that fear, you will never ever get into another good relationship, because before it starts, you already have this attitude that they're going to cheat on me, that it's not going to work. And as a result, you don't even dare to get in anymore. And that's what happens to most people. So the same thing can happen in investing. That if you always have this attitude that, this is going to fail, this is going to fail, guess what? You may never ever start investing. You may never ever get into the markets. So a lot of people, what happens is that initially it may go up and they say, hey, I'm not going to get suckered in, right? And thing is this, if you didn't buy here, it's very hard to buy here, because you're going to say that, hey, I should have gotten in here, but now it's gone up too much, I'll wait for it to come down. So when it goes up, you don't get in. Then you say, when it drops, I'll get in. But when it drops, would you dare to get in? No, because what if it drops even more, right? And then it goes up and you say, shit. And then you say, hey, I'm not going to get in there, because if I get in there, it's going to sucker me and go down. I'm going to wait for it to go lower. And it goes lower. Again, would you dare to go in? No, because what if it goes lower, right? So the point is, wherever it goes up, you won't get in. If it goes down, you don't get in. So a lot of people, they will say, I don't trust this, 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 I don't trust this. And eventually, what happens? Eventually, a bull market is born and they miss all those opportunities, or worse, they sold in fear, they never get back in, and they never get a chance to build their wealth. And this is what happens to many people. Now, am I saying that this is the absolute bottom? Of course not. I mean, who can predict with certainty? Because there are too many moving parts, there are too many variables, right? What I'm saying is this could be a potential bottom. But is it the absolute bottom? No one knows. The trouble is no one knows until it ends, right? So for example, you will never know that this is the absolute bottom until it finally reaches and exceeds their new high. And the problem is by the time that happens, it's too late to get in. Or if you get in there, you would have missed out tremendous returns. And that's the problem with people always wanting to, buy at the bottom, because you will never know until after the fact. So that's not a very relevant investing or even trading strategy. But what I want you to understand is that every bear market will end. No one knows when, but it will always end. And after every bear market, there will always be a new bull market. And here's the thing. No bull market ever starts with optimism. No bull market always starts when people are saying, yes, this is a bull market. Never. I can tell you in history, over all the bear markets and bull markets I've seen, every bull market started with extreme skepticism and pessimism. And that's why one of my favorite charts is this chart, which is the psychology of the market cycle. See, markets move in cycle, right? Markets go up and then it collapses, forms a bottom, and then goes up again, makes a new high, and so on and so forth. And again, these are the emotions that you see around you during the market cycle. And again, when a bull market begins, this is the start of the bull market. This is the bottom of a bear market, right? Now, what happens just before the start of a bull market? You have what we call severe depression. So if you look around you, most people are really depressed. Oh my God, all my money is gone. My retirement savings are gone. How can I pay for all this? I'm an idiot, all right? So I got a question for you. Last week, were you depressed? Do you know a lot of people who were depressed in the markets? If you were depressed, you know a lot of people who are depressed, good, because it could be the bottom, all right? But if you were like, I'm not depressed yet, oh shit. I hope you get depressed soon, okay? And at the early start of a bull market, you always have general disbelief, where the majority of people say that this is a sucker's rally. If you buy, you're a sucker, you're going to get screwed again. So do you believe that this is a sucker's rally? Again, I hope that most of you do, because if you do, chances are it could be a bull market, right? But if you don't, then maybe it's not. Now, this guy, John Templeton, in case you don't know him, he just passed away, by the way, right? Now, this guy became a millionaire during the Great Depression. Well, right after the Great Depression, because in the Great Depression, when everyone was bloody depressed, he was buying stocks at 50 to 60% discount. That's how he made his first couple of million, right? And then he became a billionaire right after World War II. In fact, he's very famous for investing heavily at the start of World War II. When World War II started and people say, oh my God, we're going to die, we're going to collapse, right? That's when he bought stocks. So people become multi-millionaires and billionaires, not buying stocks when everyone buys, not buying stocks when people are confident. They become billionaires buying when no one dares to buy, buying when there's peak pessimism. And that's why one of his famous quotes is that bull markets are always born on pessimism. When people are the most pessimistic, the bull market is born. And bull markets grow on skepticism. When everyone is skeptical, it's going to fail, that's when a bull market takes off. And they mature on optimism. In other words, when people start to get optimistic, when everyone is saying, hey, this bull market is real, by that time, it's like halfway up there. And bull markets die on euphoria, which means when everyone gets excited, it's time to invest. That's when the bull market comes to an end. So you got to understand this psychology. Again, I'm not saying that this is the bottom, because no one knows until after the fact. But what I'm saying is this. You can never buy right at the bottom. I keep saying that as an investor, you can never buy right at the bottom unless you're damn bloody lucky, okay? And you can't be lucky all the time. As an investor, as long as you're buying a fundamentally great business and you're buying it lower than its intrinsic value, as long as you're buying it cheap, you have done your job. Sure, it could get cheaper in the short term, and that's why we tend to average in our positions, don't go all in at once. But the point is that as long as you buy when the market is undervalued, you will do well over time. And it is undervalued right now. In fact, certain great companies are really undervalued. Now take a look at this chart. And again, like I say, every bear market is always followed by a bull market. And every bull market always delivers much higher returns than what the bear market has drawn down. And this has been from the beginning of time. Take a look, 1956, the bear market, sent the market down 21%. Following that, the bull market gained 86%. And so on and so forth, right? Down 28%, up 80%, down 27%, up 229%. 1987, market went down 34%. The subsequent bull market went up 582%. 2000, down 49%, up 101%. 2007, great financial crisis, market went down 57%. And then the bull market delivered 401%. So the market's always one step back, 2 steps forward, 1 step back, 3 steps forward, 1 step back, 4 steps forward, right? So again, as long as you accumulate shares of great companies during the 1 step back, sure, it could go another step back sometimes, but eventually when you get a 3 to 4 steps forward, that's how you build your wealth. And you got to be there when it happens. Now, a lot of people have asked me, Adam, why don't you wait for the market to be in a confirmed uptrend, a confirmed bull market before you buy stocks? Yes, I used to do this in the past. In the past, I would not buy when the market's on a downtrend, when the 50 moving average is below the 150 moving average, when the price is below the 200 moving average. I'll wait for confirmed uptrend, which is waiting for the 50 moving average, this blue line, to cross above the 150 moving average and wait for the moving averages to slope up. Then I get in. Or wait for the price to get above the 200 moving average, which is this red line. Wait for the 200-day to slope up before I get in. Yes, I used to do that. Now, nothing wrong with doing that. But the problem is that by the time the uptrend is confirmed, the prices would already have risen significantly from the lows by 20-30%. So by the time you get in as an investor, it may not be undervalued anymore. It may be fairly valued or in fact slightly overvalued. So let me give you an example, right? So again, not to confuse you, let me just remove some of these moving averages and let's just focus on 3 moving averages. The blue is a 50 moving average, the green is the 150, and the red is a 200 moving average. So again, an uptrend is confirmed. A medium-term uptrend is confirmed when the 50 goes above the 150. When the blue goes above the green and they slope up, that's a confirmed medium-term uptrend. And when the price gets above the 200-day moving average, which is the red line, and it slopes up, that's a confirmed long-term uptrend. So for example, let's take a look at past bear to bull markets, right? And you can see that, yes, like over here, for example, you can see this was the COVID crash. And again, this was a bear market. Now, initially in a bull market, you can see again the 50 blue line above the green line and the price above the 200-day. So this is a confirmed uptrend. Now, over here is a downtrend when the 50 crosses below the 150 and prices get below the 200, right? So again, if you wait for the 50 to get back above the 150 and say, okay, now it's an uptrend, I'm going to buy over here, or wait for the price to go above the 200, yes, you get in at the bull market. That means you get in only when the uptrend is confirmed. Again, there's nothing wrong with that. You can do that. And I used to do this in the past, but I don't anymore because for investing, I know that when I buy great companies, they will go up eventually, right? So I don't mind buying them a lot earlier, even if it's a temporary bear market, because I know that if I get in a lot earlier, I get them when they're really undervalued. By this time, the price would have already moved significantly. It would already have gone up by 20-30%, and they're no longer that undervalued. Now, you got to make a distinction between investing and trading. Big difference. I do both, as you guys know. So for trading, for short-term trading, I only like to get in on a confirmed uptrend. I only like to buy stocks on an uptrend for trading. For example, in my short-term trading, recently I entered into this stock called MCK using options, right? Why? Because you can see that even though the whole market is in a bear market, but this stock is on a confirmed uptrend because the 50 moving average is above the 150 moving average, right? Blue above green, and they're all sloping up. Moving averages are sloping up. The 200 is sloping up. And you can see a very nice resistance, break out from resistance, retested the resistance, and now it looks like it's going up. So this is a clear uptrend on the stock, and I will buy it for short-term trading. Because in trading, right, we don't care about intrinsic value. We buy high, we sell higher, right? It's momentum trend trading. That's trading, so it's different, okay? But for investing, I want to buy as cheap as possible, really undervalued. And that's why for investing, I don't mind buying even though it's still in a bear market, because I know great companies, they will turn eventually. And I want to get in, I can't get in at the lowest price, but I want to get in at, as low as possible, okay? Now, let's go back to 2018 and show you another example in 2018, which was another very quick crash, right? So again, you can see this was a very clear uptrend, and then boom, there was a downtrend over here, and then a reversal up there. And again, you can see the 50 crossing above the 150, above the 200. By that time, you can see that prices have already moved, again, more than 30% of those lows. So you got to understand that rationale over here. Now, you could also use a shorter term moving average, which means instead of the 5150, you can use the 2040 EMA. 2040 would be the shorter term trends that you can use, right? And you can use that as well. So basically how it works is when the 20 is above the 40, right? This red thin line is above the blue line, that's an uptrend. When the red line crosses below the blue line, that's a downtrend. Red line crosses above the blue line, that's an uptrend. So you could do this for trend trading. So I use this for trading, not for investing, right? For trading, I wait for an uptrend to get in. Some of you may have seen my recent post that I just shorted Tesla, right? I shorted Tesla a couple of days ago. Why? Because in short-term trading, it's not about the fundamentals so much. It's not about the valuation. It's all about the trend, okay? So if you look at Tesla, I'm trading it just based on short-term trends, just to diverge a little bit to share with you the difference between investing and trading. So again, if you look at Tesla, for example, is it on a downtrend? Yes, okay? So again, over here, you can see that, Tesla, it hit this resistance over here. There's a resistance level over here. It hit that resistance, okay? And the 20 EMA crossed below the 40 EMA, okay? And it's below the 200 moving average. So it's a bit of a downtrend, right? So, but it's a very short-term trade. So I just shorted it here, and hopefully if it can drop to here, I'm just going to cover the short and I'm just going to take profits. And I'm using options, which is a great thing, because with options, even if it reverses up suddenly, I don't lose very much. I lose very little with options, right? But if it collapses, then I make a lot more. Remember that in trading, you just have to be right 50% of the time, right? When you lose, 1%. When you win 2, 3, 4%. Okay, so it's about making more when you're right and losing less when you're wrong. So whether my Tesla short will be a winning trade, I don't know, right? But if it wins, I'll make a lot. If I lose, I'll just lose a bit, and that's fine. So do understand that there's a big distinction between investing and trading. Again, to summarize, let me just say this, right? For investing, 90% of my decisions are based on the fundamentals of the business. As long as it's a great business, it's undervalued, I'll buy it. Even on a downtrend, because I know that eventually it's going to reverse and be on an uptrend, right? But for short-term swing trading, it's 90% technicals. I trade based on the chart patterns. If it's an uptrend, I go long, downtrend, I go short. And for Tesla, it's basically just a technical trade because it just looks like it may retest those lows. So that's where I'm going to take profit. But it's so interesting that when I posted that, some people got so upset, like, Adam, I don't like you anymore. You shorted Tesla. This is my favorite stock. And people get so emotional about it. Hey, chill out, right? In trading, you don't get emotional. All right. Some of you, when I short Tesla, it's like I raped your sister. Come on, man. It's just a freaking stock. Okay. Get over it. Yeah. So I may short Tesla now. By the way, just let me share with you this, right? I even short my favorite companies. Like, I love Microsoft. Microsoft is in my investment portfolio. I buy Microsoft for the long run. But in the short term, I short Microsoft as well during short-term downtrends. Same thing, I love Amazon, I love Alphabet, I love Meta. These are all in my investment portfolio. I'm long in my portfolio. But in the short term, when they are falling, I short them as well using options. Okay? So whether you're an investor or trader, don't get emotional about it. Think rationally and think logically. Now, let me answer a question which I think a lot of you would probably be wondering, which is, Adam, again, is this the bottom, right? I'm sure a lot of you are asking, is this the bottom, right? And again, I'm very careful to give you an answer because, again, like, it's impossible to predict until after the fact because there are too many moving variables. So the point is this. I'm looking at the weekly candles right now. Based on technicals, if by the end of the week, we can close with a strong bullish candle, which looks possible right now, we could see some strong short-term upward momentum because this would be a very nice double bottom pattern. If this is like a very strong bullish candle, we could see some strong momentum going up. But then, of course, we're going to face resistance from this trend line, all right? And of course, it remains to be seen whether we can break that resistance, or is it going to again retest that low again. So where the S&P goes now, let me just share with you some of my targets for the S&P 500. All right, guys, catch part 2 of this video coming out really soon, where I'm going to talk about my targets for the S&P 500. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.